Ladies and gentlemen, it's a battle between oil and gas here, and I'm glad to see us well represented on the gas side. Thanks very much for coming. My name is Henry Trix. I'm the energy editor of The Economist, and we have a panel today in which we look at the supply and demand question with regards to natural gas. A few years ago, the International Energy Agency, when it talked about the golden age of gas, it left a question mark at the end. And that reflected disquiet about the ability to replicate what was going on in America around the world. Gas didn't trade across borders like oil did. There were these huge price differentials between American gas and gas in Europe and Asia. There was concern about giving too much priority to a hydrocarbon when renewables were such a favorite source of energy. So in the interim, in the last couple of years, gas's future has only got brighter. For consumers at least, although not for producers necessarily. This windfall in America is now being replicated elsewhere. We were just hearing from Seth about gas prices in Asia and this extraordinary wall of gas that he talked about that's coming up from Australia. Gas has become a mainstay of the power industry around the world, pushing out nuclear and reducing the amount of coal used. In China now, vehicles are being pioneered by natural gas. Basically, gas sits on that excellent fulcrum where it satisfies energy security, and it also helps with the question of climate change. It's the sweet spot, as they say. That's gas around the world, but America is the heartland. And here today we're going to be talking about mostly about America. We look at the upstream where there's the glut, the places where there is demand, and the midstream and the complex process of transporting gas. In order to talk to you about this, I have we have some experts here who Genscape has gathered together. On my right, Randall Collum. He's managing director, supply side analytics at Genscape. Next to him is Andrew Weissman, senior energy advisor at the lawyers Haynes and Boone. There's Vince Morissette. He's the vice president of organization and regulatory affairs at Repsol Energy North America. Matthew Sir is the director of fundamental analysis at Calpine, and Terry Viswaneth is director at the commodity strategy natural gas at BNP Paribas. They're going to talk to you. They're going to make presentations of about 10 minutes each. And then we'll have some questions afterwards. And I would really encourage you to ask as much as you can, and for the panelists themselves to engage in questions and discussion amongst themselves. So with that, can I hand over to Randall? And go ahead.
Hi. Good morning, everybody. Thank you for that introduction. Today I'm going to talk about gas production. Like I said, I only have 10 minutes, so I'm going to make it relatively brief. But if you have any questions, we have the 30-minute session at the end of it. And then afterwards, if you want to come talk to me, feel free to do that. Today I want to talk about the oil price impacts that have been felt on the gas industry and how that's changing gas production. And just a little bit of background on myself. I'm actually a petroleum engineer by background. Started my career at BP, worked at Merrill Lynch Commodities on the trading side of things, and I've been at Genscape now for about 4 years. So, everybody's seen the oil rigs. They've basically fallen dramatically, almost 60% since October of last year. We actually believe oil rigs are on the decline again, are going to continue to decline through Q1 based on current prices. We have seen price-related shut-ins in the Marcellus and Northeast this year. So the way I kind of divide up the I guess, gas production landscape is two things. There's the Northeast, which is highly productive, big production growth potential out of there, and then there's the associated gas piece, and there's been a lot of gas production growth out of there over the last few years too. We believe that going forward, that's the gas production piece that's actually going to slow down quite a bit, and that's mainly due to the lack of rigs drilling this for the associated gas plays. The Marcellus Utica, we believe the production capacity is there. I'll show some of the things that are associated with that, but if there's a price high enough, there's plenty of gas production in the ground there to last for the next several years. Basically, the producer can grow as much as they potentially can on export capacity. The well capacity is there for at least the next 4 or 5 years. The associated gas, the capacity is also there. If you get a price signal, you can go get more gas out of there. There's a plentiful supply of natural gas production in the lower 48 and North America right now. And then lastly, I plan on talking about kind of the risks to this, what could change everything in our forecast. This is a graph I like to show comparing kind of the last downturn, 2008, 2009. We basically peaked in oil prices in June 2008. We started going on the decline, and then rig counts peaked in October 2008. And then they went on a hard decline. And then this last year, rigs peaked in October 2014 and have been on the decline since. And impressively, they followed pretty much the same path. On a percentage basis, the 2008-2009 downturn declined a little bit more on a percentage basis, but it actually also rebounded much quicker. Right now, we flattened out earlier this summer. Oil got back up to $62. Oil crashed again. Rig counts have started going the opposite way, and we actually believe they will continue to decline through the end of Q1. And this is our rig forecast. We actually, at Genscape, we look at the economics of the different plays, and I'll show you some of the economics in a few slides. But when we're forecasting our rig counts, we look at the economics across the lower 48. We look at the prices by region, the gas prices, and also the oil price. And we forecast our rig counts based on that, and that kind of leads to our forecast. We use rig data as our source of rig data, and I don't know how many of you are familiar with the rig data, but it's basically who Baker Hughes is using for their rig count. You just get a lot more detailed information. Rig data was started in the 1980s as a source for service companies to know who to go call on to get to sell the rig products to. And it has, if you look at the information, it's got information on the rig supervisor, his phone number, and back in the 80s they used to put the favorite whiskey of the rig supervisor's name on there to go sell. But as you can see right now, at current oil prices, we think there's going to be another 160 oil rigs dropped by the end of Q1. A question Andy asked earlier, what happens if oil goes down to $40 and stays there? We actually think that could drop off another 150 rigs, so we could end up seeing another 300 rigs drop. That would get us below the lows of July 2009 in oil rigs. Right now, we're still about 250 rigs above those levels. There's been a topic thrown out there a lot, and you've heard it really a lot this year on the associated gas side, is the deferred inventories. What's this deferred completion inventory? And if you looked at it last year, there was a lot of reports on that, and there's always been this big deferred inventory in the Northeast. But the way this deferred inventory has gotten built up on the associated gas side is due to pad drilling. So as there's pad drilling, let's say if they're drilling a 6-well average pad size, if you're on that 6th well, you always have 5 wells in your inventory. If you're on that first well drilling, you only have 0 wells in your inventory. So say you're running 100 rigs in a basin, like the Permian Basin. So you would always have 3.5 wells per rig, 350 wells in what we consider your normal deferred inventory. Well, as you drop from 100 rigs to 50 rigs, you only have 150 to 175 wells in your normal inventory. So there's an extra 175 wells that after those rigs leave, need to be completed for production to be brought online. So I like to show Texas as an example of this. If you look in 2008, 2009 when the peak happened, production peaked about 3 months after the rigs peaked. This time around, we believe it's more of a 6-month lag between that rig count peak and the production peak, and that's because of the deferred inventory filling that gap. We actually believe most of the deferred inventory on the associated gas side will be depleted by the end of this year, and that's what's going to allow for production next year to actually, in our opinion right now, we think production from the gas side is going to decline. So here's what's basically happened in lower 48 natural gas production for the last 6 years plus our forecast. And if you look at this, we've been pretty much growing for almost the last decade. We've had peaks of 4 BCF a day of growth in 2011, 2014, 2015 looks like it's going to be about 3.7 BCF a day of year-on-year growth. And if it weren't for the price-related shut-ins in the Northeast, you'd probably be at record growth of close to 4.5 BCF a day. And we've broken this out by what we consider kind of the three main pockets. You've got East Texas, North Louisiana, which is basically the Haynesville Shale. 2010, 2011 was helped driving the gas production growth. The Marcellus and Utica started around 2010 growing, and it's just been continuing to grow. And then you've got the associated gas phenomenon, which is right here. And you see how it's just continued to add gas production. And then last year we added 2 BCF a day. And this year we've added another 2 BCF a day of gas from associated gas production. And a majority of this is because of that deferred inventory that had built up from drilling. Next year, the associated gas goes to pretty much flat. So basically you've been growing like this, you're gonna start going like this, and so year on year you're gonna be relatively flat. And let's focus a little bit on the Marcellus and Utica as that half of the pie, I guess. So 2014 was kind of peak growth from the Marcellus Utica, about 4.2 BCF a day. This year is going to be around 3.1 BCF a day, but if you add back the producer-related shut-ins, you'd be closer to 3.7, 3.8 BCF a day. Next year, we have it going down to 2.2 BCF a day growth, and that's only because at current prices in the Northeast, we don't believe the deferred inventory that's there will be completed. Right now, we have about 800 wells, and I'll show you how this has been building up over the last 8 months, really. When you look at the Northeast, you not only have this huge deferred inventory that could potentially lead to more growing production, but you have a lot of wells that are in this constrained pattern like this, to where basically the Northeast is almost acting as a storage reservoir. So if you relieve constraints and the prices are there, the producers will flow the gas, and they could flow this quite a bit more. The big thing about the Northeast is that these wells, even the producers can't even pick within 6 months when they will start to go on decline. So if you just have 100 wells and they decline 6 months earlier than what the potential is, that's 600 million a day off just from 100 wells if they decline earlier. On the other side, if they decline later, then that's an extra 600 million that just could come from those 100 wells. The productive capacity, well-productive capacity, is quite a bit in the Northeast, and there's nowhere else really in the North America that's like this. I like to always show our economics that we look at in a lot of these regions and how they've changed. I've got a few minutes left. But if you look here in the Northeast Pennsylvania, this is a break-even point at different oil prices, and the northeast part of Pennsylvania is the dry portion. Right now we're at a $2.31 break-even point, kind of 10% IRR. If you were to look at this data in January, we were showing a $2.76 break-even price. Since then, CapEx prices have gone down 8% just since January, and lateral lengths have increased by 12%. So that's improved the economics by 45 cents. So if you'd have talked to me about the Haynesville in 2009, I would have told you the break-even price was $6. Nowadays, it's closer to $3.50. Operators are continually improving their processes and driving down the economic prices. But right now, Dominion South for 2016 is trading about $1.80, $1.85. That's why drilling has gone down so much. I talked about the price-related shut-ins that have impacted gas production this year. We saw Chesapeake. They have really tied their gas production to prices in the region. Now, on December 24th of last year, they shut in half a BCF a day. It coincided with the drop in cash prices. And we think the average operating cost in the northeast part of Pennsylvania is about $1.50. Once that pricing point went below the $1.50, they shut in production. They've been one of the few that have actually actively managed their production. You've seen it change, and they've had a pretty good correlation of price. Cabot Oil, on the other hand, kept growing production in these low prices. And in April, they made a decision to shut it in because of low prices. It was a corporate decision. They weren't making day-to-day decisions. As of now, these companies said they are staying shut in for the foreseeable future. In our forecast, we have all this production coming back online in December of this year because that's the point at which the prices go back above $1.50. We believe that the potential for volatile production this winter in the Northeast is high. So as days of high demand, high prices, you could see spikes in production. And we think it can move as much as 2 BCF a day. With the low gas prices that have shown up in the Northeast this year, the deferred inventory has been building up purposely by these operators. And you can see in the Marcellus, it's up almost 120 wells since the end of last year. and the Utica's up about 130 wells. So that's 250 additional wells. And if you look at the total well inventory, you're talking well over potentially 10 BCF a day of potential gas production just sitting there in the deferred inventory if you brought it all online at once. Real quickly on the associated gas piece of things. Like I said earlier, we've been about 2 BCF a day growth last year, 2 BCF a day growth this year. I mean, when your oil rigs have dropped, near 60, 65%, and the deferred inventory runs out at the end of this year, it just basically leaves little for growing production extra on the associated gas front. What's helping to keep it from declining is the efficiency gains we've been seeing. This is just an example in the Permian. You've seen the total percentage of horizontal rigs just go through the roof since rigs declined. We're close to 85%. We're expecting efficiency improvements in the Permian Basin alone this year of close to 60 to 70%. Next year, we're assuming another 35% efficiency assumptions in our forecast. It's also the first time in over a decade from the associated gas standpoint that the Gulf of Mexico has actually grown production. We saw Tubular Bells, Lucius Hadrian South, LLOG's new field came on as well. Has actually grown production since the beginning of this year. Now that all those have pretty much plateaued, you'll start to see Gulf of Mexico production go on decline again. Talked about how we look at economics a lot, and we have basically built out probably 150 individual regions within each play in lower 48 looking at the economics, because you can't just look at it on average. You have to look at each operator, because each operator drills wells differently. They spend a different amount on wells. They get a different EUR depending on how they spend money. So we've looked at all these analysis, and you can see right now at the 10% break-even point, there's quite a few of the prospects that aren't economic. And if you look at a cutoff at 20% where these guys are going to go invest, you can see why rig counts have dropped 60 to 70%. You look at Pennsylvania from their peak in 2012, they're down about 75%. Ohio, just since December of last year, the Utica Shale is down almost 60%. Permian, 60%. South Texas, 65%. North Dakota, almost 70%. So to conclude, oil rigs have fallen dramatically. They will continue to decline, in our opinion. Close to 200 rigs going to be dropping by the end of Q1. Lower 48 gas production, we don't think it's actually peaked yet. It's been pretty flat for the last several months, but we believe this winter, when all the price-related shut-ins are brought back online, most likely in December, that will be the peak of gas production in the lower 48. However, I'll caveat that by saying if the basis price improves in the Northeast, all that well capacity is there. We actually think there could be as much as 2 to 2.5 BCF a day of additional production in 2016 just if they get better pricing. And that's why the Northeast is the wild card. It will act as storage. If prices are there, they'll flow it. If they're not, they won't. And we've seen them do that for the last year. The correlation last September and October between production and prices was like 99%. So as prices went down, production went down, prices went up, production went up. We see that happening pretty much all winter this year.
Great, thank you.
Thank you. I'm really pleased to have the opportunity to speak to you today. Let me start by addressing an issue that Henry raised at the outset while the slides are being pulled up, and that is the role of natural gas in the U.S. as a source of clean energy. And what I want to emphasize, is I hope it'll be of interest to this audience, is that there's been a fairly major development just in the last 2 months, which is very negative in terms of the use of natural gas as a source of clean energy. And that is the Obama administration's Clean Power Plan. And the way that plan came out, I mean, if we look at what's going to happen with natural gas generation in the United States, over the next several years, we will continue to see retirements of coal-fired plants and some additions of new gas-fired generation. That's driven in part because of some of the environmental requirements, like the mercury and air toxics rule, and it's driven to a very substantial degree just by the economics. But if we look forward further in time, there's really been a huge setback, and one that I think an audience like this should focus on, and that is, as originally proposed, the Clean Power Plan potentially would have resulted in, the Clean Power Plan is the name for the Obama administration's program to reduce CO2 emissions from power plants. As originally proposed, it might have resulted in the addition during the next decade of as much as 40,000 megawatts of additional gas-fired generation. Now, exactly what happens remains to be seen because the implementation is going to be state by state, but essentially the short version is essentially that the final version of the rule has a fairly strong bias against the addition of new gas-fired generation, and the analysis that's been done by ICF Incorporated indicates that rather than resulting in the addition of 40,000 megawatts of new gas-fired generation in the next decade, and potentially increasing gas use by as much as 10 BCF a day, that the new rule will very, very strongly favor renewables and energy efficiency to a degree that, at least according to the modeling, the construction of new gas-fired generation might basically come to a halt. Their estimates indicate that actually there'll be almost zero new gas-fired generation built, and less than would occur if there were no clean power rule. So I mention it just because I think the point that Henry raised at the outset is important, and it's important to be aware of what's really happening. I'll essentially skip over this. We have a publication that looks at the electricity and the natural gas, electricity, and oil markets on a daily and weekly basis. What I want to talk about is the changes, and let me just make sure. It looks like I'm really not exactly sure what happened. There seems to be, I apologize, a little bit of glitch in the organization of my slides, but basically I just want to hit on a few major themes. I think where we sit now is that there is at least the potential for a massive increase in demand for natural gas produced in the United States. Exactly how much demand increase will occur is the key question, as you heard in Jim Duncan's opening remarks today. And so the numbers that are just up there, are the potential increase, not what we're predicting will occur. And the question of what the difference may be between those values is a key point I'm going to focus on. From my standpoint, I think there's no question that even if the increase in demand is at the upper end of that range, there's plenty of gas available for reasons we can talk about in response to questions, but I suspect most of you are aware of. Just a brief note, and really to comment specifically on one of the points Jim's made. This year, if we look forward to the next 12 months, we think there are a range of scenarios that are possible as to prices, and they will depend in part, really, essentially, in our view, on two primary factors. One will be weather, and the other is Randall, I thought, had a terrific presentation really about as clear and precise an explication of natural gas, potential natural gas supply as I've ever heard, and I actually don't think you can do it a lot more, that there is any greater transparency available than the presentation that Randall made. I call your attention to one point that he made that I thought was particularly important, and that is this, if I understand correctly, the swing potential just in Marcellus shale alone, based in large part on prices, is potentially as much as 2 BCF a day, even short term. And that's a theme I'm going to, both short term and long term. We see prices driven, essentially a core part of the way we look at the market is that we see kind of, if you listen to most analyses of the natural gas market, they tend to give you a single number for demand over the course of the year and a single number for supply during the course of the year. Those analyses are important. You need that as a starting point. But we think what's critical in analyzing the market and what we've tried to focus on our publication is that what will happen in practice is there's a high likelihood that it'll be much different than what that starting point suggests. And it'll be much different in really primarily for two reasons. One is that on the demand side, there's a substantial likelihood that one way or the other, weather will result in demand being either much higher or much lower. And secondly, as Randall's comments indicate, we're moving into a world in which, with a time lag, supply tends to be much more sensitive to prices than it's been in the past. And so essentially what we try to do is we try to analyze the market in a more dynamic manner, both short-term and long-term. And won't go into our current market assessment in any depth now. We're actually putting on a free webcast on October 8th with a shameless advertisement for that. If you go to ebwanalytics.com, you can register for that webcast, and you'll hear our short-term market assessment. As we'll explain then, as it relates to Jim's question this morning. Jim commented that we've had 4 years in a row in which weather forecasts have been based on El Nino, and then we haven't seen the El Nino develop either at all. There are reasons for that, and that we will explain those reasons in our webcast. If you understand the factors that are driving that, what it tells you is that there are very different weather scenarios that are possible for this winter, and we'll go into that in detail and explain how to take that into account in assessing the market. Now the main point I want to make, and I'll try to make it just solely off this slide so that we can say as close to schedule as possible, is that I think we're moving into a world of a whole new industry paradigm, and that essentially what we're going to see is the potential for far greater price volatility in the market than we've seen for a long time. And I'm not saying that that's going to happen immediately. I think in the next 12 months, prices will still be in a narrower range, but that there are changes in the winds that as we get further into the decade, I think are going to create much greater price volatility. What are they? I think the two most important things, I'll emphasize three things. First of all, on the demand side, I think we're going to see there is far more potential, far more uncertainty, and far more greater potential swings in demand than as we look further in the decade, that there are far greater swings in demand than we've ever seen before. And there are basically three components to that. One is volatility in space heating demand. We've actually seen during the last 4 winters a difference of almost 4 BCF a day between space heating demand in the mildest year and in the coldest year, and that could increase in the future as use of natural gas for space heating continues to increase. Secondly, as we rely more and more heavily on natural gas generation in the power sector, that also will be highly weather sensitive. And then the wild card of all wild cards is what's actually going to happen with utilization of the LNG export facilities that are being built out now. Potential for huge swings in demand depending on the utilization of those factors. And at the same time, the third thing that's changing is that what we've seen up until now is that we've had a safety valve in the market that tended to moderate the swings in natural gas prices in either direction. And that safety valve has been the ability to switch back and forth between coal-fired generation and natural gas-fired generation, and to stay at a high level that capability is already diminishing rapidly as coal plants are retired and gas plants used more heavily, and it's going to continue to diminish. So if we look just back as recently as 2012, when we were oversupplied in the market and we had relatively mild weather, that essentially what happened, the reason natural gas prices dropped to $2 was that prices kept dropping and dropping and dropping until the economics of using natural gas became sufficiently favorable relative to coal that use of natural gas fairly quickly increased by 10 BCF a day. Huge factor dampening price swings. And we saw a similar effect in the other direction during the polar vortex. That's already been cut by more than a half, and it's going to continue to decline. The last point I'll make, just to try to stay close to schedule, is that you put those factors combined, the potential for huge swings in demand. And I emphasize the scale size of these LNG facilities. Essentially, fog in Sabine Pass could cause a sudden drop in utilization of natural gas that for whatever number of days it persists would be about the same scale once all the export facilities are built out, about the same scale as suddenly ceasing to use natural gas for power generation in Texas. So we're talking about huge, both short-term and potentially longer-term swings in demand that the market has never previously had to cope with much less dampening capability to dampen price swings through switching back and forth between natural gas and coal. Why don't I stop there?
Great, thank you, Andrew.
Well, thank you very much. I certainly appreciate the opportunity to speak here at the Genscape conference today. I'm going to talk about the last real market for LNG imports in North America. And a lot of you may or may not be aware, but there is a viable market in the Northeast in the New England area where that last mile of pipe hasn't been built yet to connect the Marcellus and other sources of supply into a very lucrative winter market that swings rapidly as the weather changes. Since we're short on time, I'm going to really go quickly through Repsol overview. I really want to get into the last two winters up in the Northeast. If you trade in that area at all, you know what kind of price swings we've seen. Talk about imported LNG versus pipeline expansion, and then talk about the dynamics of LNG and a peaking service that we offer. Once again, this is Repsol overview. We're the 15th largest publicly traded oil and gas company in the world. We are a Spanish company, about 1 million a day of refining capacity, 600,000 barrels a day of production. In North America, we started our business here in North America about 2008 with our Canaport LNG facility up there in the upper right-hand corner. It can put out about a BCF a day of gas. It has about 10 BCF of storage. Very important to the Northeast market because you can backfeed the system, so all the pipeline constraints from west to east do not inhibit the ability of that facility to put gas into the market. So when the market needs it, it can react very quickly. We've recently acquired Talisman Energy. That acquisition closed in May. With that, we got a lot of production in various areas in North America. We've got Western Canadian production, about 200,000 a day, Marcellus of greater than 500,000 a day, and Eagle Ford of about 100,000 a day. The last two winters had a drastic change. If any of you were paying attention in 2013-14 or trading the Northeast market, they did have spikes up there in New York that exceeded $100 per decatherm from the daily prices. In New England, that price wasn't quite as high. It got up almost to $80 a decatherm on a couple days. The problem there was New York. They had some nuclear facilities or a nuclear facility that went offline, and a compressor outage at a key compressor station on one of the pipes feeding the area. So actually, New York was pulling gas over from New England, which caused the similar spikes in New England. But capacity was not an issue in New England itself. It was a New York problem. It was just the market pulling the prices higher. Fast forward to this past winter. If you look at February, the actual average Boston temperature was 10 degrees cooler at 19 degrees average for the entire month. You didn't see nearly the price swings. It got up almost to $30 on one day, but that was quite a difference from the previous winter. One of the reasons for that, or several reasons for that, number one, based on the prior winter, more LNG was brought into the region. Between Everett and Canaport, we brought about 40 BCF in the region. Those are the two big facilities that serve that. There are also two offshore facilities in Boston that hadn't been operational in several years, but one of them actually brought in a cargo and put about 2.4 BCF into the market that had the effect of dampening prices to meet that peak demand. New England ISO implemented a reliability program where they incented generators to have oil on hand so they wouldn't get caught short during the winter. So there was oil forced into the market, oil-fired generation. That, of course, decreased the demand for gas for power generation and kept those peaks from occurring again. And then, of course, the market was just ready for it. They saw the $80 prices the previous year, so they made adjustments in their portfolios to react. Another difference was, though, that it was actually a much colder winter than the previous winter. It was persistently cold for the last half of the winter. I showed you those February prices, but it was cold all the way through March. So you had very, very persistent high demand during the winter. Once again, I talked about the importance of the backfeed supply into New England. Three primary sources. You've got offshore gas coming in from Nova Scotia. There's two fields, Deep Panuke, which is in Canfield, and Sable. Both are on rapid decline. Some of that production, Deep Panuke, has been actually shut in for the summer because of price signals. They're going to bring it back up in the winter. Total production there is about 300 a day. That total market between Portland and all of Maritime's Canada pipeline is about 600 a day on a peak. It probably averages about 300 a day. You cannot bring gas up from the south yet due to pressure differentials on the pipeline, so it's an isolated system. The LNG is very important to cover the swing load. During the summer when prices are low, it's a self-contained market. No gas comes from that system into New England. They don't need it. During the winter, there's excess gas that goes into the New England market because the prices allow for such to happen. This unique issue to New England, these are all the power generation facilities greater than 100 megawatts in New England, the gas-fired ones. The New England market, all of the capacity into that market is owned by the LDCs. The power gens have rarely bought capacity. They use it in the summer when it's available when the LDCs aren't using it, because that's when you have peak power gen. In the winter, they're a discretionary market. That's where the backfeed supply really comes in. We're supplying that discretionary market up and keep the lights on. This shows basically the two major pipelines that feed New England, Tennessee, and Algonquin. This shows the backfeed supply that comes in. As you can see, it just peaks out in the winter, almost goes to zero during the summer. What's noted as M&P there, Maritime's Northeast Pipeline, that's primarily Canaport LNG. So it's a big swing supplier in those markets during the winter months. Once again, this shows the red area there is basically the LDC load. The green area is power gen load. That's 100% of the market in New England. There's very little industrial demand. The red line, solid red line, is the capacity of each of those pipelines, traditional west to east capacity. The solid bars above that are some of the expansion projects that are planned up there. The highest bar on the Algonquin side is a project called the Access Northeast Project, which is a project in which they're trying to accommodate reliability for power gen. As you can see, that's a lot of excess capacity. They're trying to figure out how to basically pass that cost on to the consumer. I don't think that one's going to go anywhere because of the big amount of excess capacity that the market doesn't seem to need, especially with that backfeed supply. The black line just shows what was shown on the previous gas, how that backfeed supply captures the peak when you exceed that capacity that goes from west to east. So one of the issues we've been dealing with up there is competing with these expansion projects, trying to basically convince the market to utilize existing resources, utilize the 10 BCF of storage that we have. There is no storage, underground storage in New England. The geology doesn't support it. So if you look at truly what the market needs, 30, 60-day service, if you take 365 days of demand charges, convert those down into a 30 or 60-day cost, you see that the actual cost of that capacity is staggering on a decatherm basis. For a 30-day service, you're talking about a $25 a day demand charge, equivalent demand charge to a $2 expansion cost for a 365-day a year firm service. 60-day, of course, is about half that at around $12. LNG, we see, will be very competitive for the foreseeable future. I think you might have heard in this morning's presentation, there are a lot of new projects coming online. Demand is not growing. Japan's nukes are coming back on. As we speak, they have loaded a maiden voyage out of the Gladstone LNG project in Australia. So we think prices are going to are very competitive in New England, or for the New England winter for some time to come. This shows that graphically throughout the world, comparing 2014 to 2015 February prices. You'll see the prices are almost half of what they were in just 1 year. They're even lower now. Asia just this week posted sub $7 spot prices in the LNG market. Once again, that'll be very competitive with the winter prices in New England. So we think once again that will attract LNG cargoes into that market. This shows the new projects that are coming online between now and 2018. These are only the ones coming online in 2018. There are several that aren't included, such as Cove Point, Freeport, others that are under construction and under development. Mozambique, Egypt just had a big discovery. But the bottom there, you'll see that's about 13 BCF equivalent of gas. Worldwide market for LNG is about 35 BCF. That's a huge increase between now and 2018. The market's not going to grow that quickly. Just by comparison, the U.S. market is typically about 75 BCF a day, peaks out about 130 BCF a day, so it's a very large amount of gas to serve a relatively small worldwide market. The market's starting to take note of this. This was one of the trade rags from Monday, talking about the oversupply of LNG may deep six some of the New England gas pipeline projects. It's not going to deep six any of the ones that are currently contracted, but some of the future ones they're talking about, like I mentioned, probably will be at least downsized, if not eliminated. Once again, we offer a peaking service to accommodate the markets up there in these winter periods of high demand, to basically serve the market with LNG, that backfeed supply. We can structure this in many different ways. We offer a demand charge with a commodity charge type. We can give you 30 days of peak over a 120-day period. We can give you 30 days of peak over the entire winter, 15 days, whatever you need, whatever volume. Typically, we have a must-take volume in there so that we know that we're going to sell that LNG or get it out of our tanks during the winter. But in any event, it's been a successful program with the market. We're trying to do it for longer term now, once again, to accommodate their needs in lieu of pipeline projects. Okay. And basic conclusion really is what I've already stated, that we are a big proponent of utilizing the existing resources instead of buying expensive new pipeline projects. Thank you very much.
Thanks for having me today. I'm with Calpine, and we are let me get past this. We are the nation's largest independent power producer that's focused on gas alone. We have about 22 gigawatts of just purely combined cycle gas that includes cogens. We have a small renewable footprint and some simple cycles. 3 real core regions are California, Texas, and PJM. We have been expanding in New England too. So what I have here is just kind of a view of sort of new builds from 1960 on. And I think there's 3 important points to point out here. Is one, you can kind of see the boom bust cycles, right? We overbuild, then we underbuild, then we catch up, then we overbuild. Number 2 is, for all the discussion about fuel diversity, it seems to be an accident, not done purposely. In the 70s, when we had a shortage of oil and we needed to make a transition, and gas was tight, we built coal and nuke. In the 80s, we still had the hangover from high oil, and we were still using domestic fuels. The 90s, as we see some uncertainty, but gas is cheap and we can start building gas generation again, we do that. 2000s, gas generation, when gas is cheap. Towards the back half of the decade, we start to see wind. We sort of think of the next era as the era of lower emissions. So what's going to drive the new builds in the near future is lower emissions. Okay, so this kind of gives you an idea about our scale. So what I have is the top 5 producers, gas producers in the US. And what I have is our daily consumption through, kind of just based on SEMS data. So we consume about as much gas as, about the 5th biggest producer in the United States. This summer, we got up to 2 BCF a day a couple times. So, and on an annual basis in 2009, we burned about 9% of the gas used for power generation. So there's really kind of 2 themes. And actually, Andrew and I probably could have gotten together and done the same, put a presentation and call it the wild ride of gas demand in the future. So near term, everybody knows about the coal retirements. 2 factors to the coal retirements, and I think you needed both of them. One was you needed the EPA to make stricter rules. And the other one is you needed low gas prices. Each of them separately wouldn't have done the job because coal plants would have probably made enough money at the low gas prices to cover their costs. They needed the threat of that they had to put capital back into them. $14 gas prices in 2008, wet scrubber is a no-brainer. So you needed both of those things to happen. And what you see, though, even of the stuff that's retiring, we looked, it's become less important. Gas is making it less important already. So, by 2020, we think there's maybe another 40 gigawatts, but, that changes. It could be bigger, it can be smaller. My CEO once told me I didn't know bunk beyond 5 years. So, it's hard for me to really get that, but, he just feels like the market is so unpredictable in this sense. It could be higher, it could be lower. So here's the other big theme, right? And it's not just renewables, but it's the volatility that renewables create for gas demand. So the left is, I guess it's your left. Your left is a graph of, it's a June day in California. And the red spike is power prices, and the green is intermittent generation, and the left axis is air. So what happened on this particular day is the CAISO under-forecasted load. They over-forecasted intermittent generation, and what they got was a price spike. So renewables add another layer to volatility. And how does that price spike get solved? By quickly ramping up gas generation. So suddenly, we don't just have, we can have a real spike in gas generation. The graph on the right, it's based on plant capacity factor for the day. So the bars are wind generation in Texas. The red sort of flat line is a coal plant, and then the line that ramps up and down is one of our combined cycles. And so what you see there, right, is the shape throughout the day, right? So, flexibility matters in the future. All right. So, final slide to kind of get to our big points. This is our capacity factors over the last 7 years, and we can kind of converted them to gas equivalent sort of demand, which I point out right there. But, this March was a historically low capacity factor. And we think that caused about an extra half a B a day of demand in March for just Texas. That poor wind month, if you look at the graph down on the bottom left, the blue line is where they didn't have very good wind. It was a national trend, right? It wasn't just a Texas trend. So when Andrew said that there's going to be more volatility due to the weather, it's not just the temperature anymore. We're going to have springs where there's a lot of wind, it's warm, and we're not going to know what to do with the gas. And we may have springs where it's still warm, but there's no wind, and we're burning a lot of gas. Renewables add an extra wrinkle to that volatility, and they add it on a seasonal basis when we'll have way too much gas sometimes and not enough others, but they add it on a daily basis too. And the market's going to need to, and so our sort of view is the gas market's going to have to start adapting to that. us as generators are going to need more intraday and balancing services. It's already underway right now as far as the coordinating the power and gas days, but that is an issue too, and FERC has been actively working on that one, and the ISOs are in the process of implementing that. And then, the grid operators are going to need to be able to deal with this uncertainty too, as to how do you keep gas generators around to get, to do this balancing service, because you're going to have low sort of energy prices, but you're going to still need people to balance the gas or to balance the renewables and intermittent. So that's it.
Great. We're on time, folks. Oh, great. That's the best shot.
Okay, great. So I'm Terry Vishwanath. I'm the gas strategist from BNP Paribas. My job at the firm is to come up with a price forecast for natural gas, a regional and a Gulf-based price. And that has been a real challenge in the sense that not only the cost of gas is moving lower, so the issues brought up by Randall, but also, the demand side, the story that we talked about a little bit about that change that's occurring. It's made that dynamic very challenging, but most importantly, the delivery system, the midstream, how we transport, store the gas, is radically being reinvented, and that has a profound impact on supply availability and the cost of that supply. So when we think about, the three major areas that I really want to make sure I leave you with the takeaways is that, the abundant gas has really spurred an unprecedented level of construction in this country. So right now, if we include kind of last year, because we're still in this big boom, if we take a look at the projects that are on the drawing board, you've got 40 projects that equate to, just out of the Northeast, 40 projects equating to 33 BCF a day and at a cost of about $20 billion. So very expensive. When we look at the other side, so, if we don't build a pipe, and another way, and we need to think about storage, is another form of transportation, a means to get the gas to consumers. It's a cheap form of building a pipe, if you will. Storage is just flatlined. There is no storage. There is no new development occurring in storage, and that is really important because what's occurring right now, and Randall kind of talked about that de facto storage occurring in the basin. So, the fact is that an uncompleted well is a de facto storage capacity for the market, and we certainly see that occurring in the Appalachian Basin. But beyond this, we have some real changes occurring in the marketplace, and we're not building any more storage, and we may miss the boat in terms of the needs and requirements of the market moving forward. And I think that's important to sort of leave you with. And then the last, that overarching theme is that we're seeing massive transformation occurring, and the pace at which the transformation occurs will really have a strong impact on how we think about prices. So first, the need for reinvention. I love this map. This is an EIA map, and it was developed in 2008. So right before we really got some traction on the shale development. And what it shows you is that we have 11 major transportation paths occur. Now, 5 of those are out of the traditional Southwest Basin, moving the gas from the Southwest, that line into Florida, that first Southwest to Southeast migration. And that sort of has been fortified with some of the east to west pipes out of the region. The traditional path 2 from the southwest into the northeast, there's about a little over 10 BCF a day, 10.2 BCF a day on that path alone. And then another really massive transportation path, getting the gas from the southwest into the Midwest consuming heating market. That's about 7.8 BCF a day, major pathing into this region. And then the paths to the Panhandle, the Mid-Continent region, and then out to the west. Those are the major out of the Gulf. As we needed, as we were, especially during the 90s, that need for new frontier gas. Frontier gas was considered with the development out of the western Canadian basins. And that pathing that developed out of Canada, first into the western market, serving more localized markets in the west, transporting into the Midwest, into the Northeast, and then furthest out to the Northeast region. and offshore, the last sort of development. And then the Rockies, the Rockies development. It's crazy to think about the Rockies development, but the Rockies Express pipeline, it was a massively expensive endeavor, 1,700 miles of greenfield pipe to the tune of $3 billion. And that was an unprecedented, the largest pipeline project that actually commenced final service only in 2009. 2 years later, we wondered if that was a bad idea. But all these projects really, are set up to take gas and deliver it to consumers. And that, once again, 2008, that's sort of that connectivity, shows the connectivity. And what it set up in terms of pricing was this idea of supply basin parity. Okay, so your cost in the Gulf, it's basically the same amount of money, and so you'd see that competition with the Rocky supply out of Western Canada. So we had this supply basin parity. All sources of supply kind of were priced at the same price level. They cost about the same to develop. It's just getting it transited. And once we sort of got the pipe there, the Western Canadian supplies floated up. You had pricing parity. Then we connected the Rockies, pricing parity. Now something's changing, and something that Randall alluded to. These basins, not all shale basins are alike. There is a difference in the productivity of those basins, a difference in the connectivity of those basins. But we know that they're steeply discounted. With the service cost adjustments, definitely that floor is lower. And, Randall does a much better job. So I actually grabbed this one from Bloomberg. But I think the story is that we have a lot of resource base, and it's very cheap. In fact, all of a sudden, our center of gravity used to be, our producers. I'm obviously at a bank, we're an intermediary. That's what we do. We lend, and then we try to hedge that supply. That's all we do. Okay. And the target was like a $4 Gulf-based target. That was sort of the target. Now, based on the cost of supply and availability, it's probably shifted down. The center of the universe now looks a little bit like $3.50 price. But location is key. Location is important. Since 2008, it's amazing. We've had a whopping increase in supply. 85% of that has actually originated out of the Appalachian Basin. That is Marcellus, and more recently the Utica supply. Over time, over the next 5 years, 10 years, that's not going to change. In fact, we see in terms of all shale production, Marcellus will account for 50% of all shale supply, continues to grow at pace. It's going to be an important story. In fact, growing so much, once again, I stole a slide. I think this is a great slide because it shows what's occurring in the Northeast Basin, which is, obviously, this is a dominant area for heating demand, for power generation. And what we're seeing, that top graphic, this was prepared by ICF, and they say even with the growth, and it's basically in line with the growth I see through 2025, is that, certainly there's an excess available of production available for other markets outside of this region. And largely when we think about the growth opportunity, where's demand growing? The demand story predicated by industrial, we're seeing a lot of redevelopment along the Gulf area for our industrial demand. We also see the LNG story, we also see electric power. 80% of gas-fired generation is in the eastern half of the country. So roughly 235 gigs out of the 310 installed, that's an eastern grid. Of those that are scheduled for retirement, they're happening in two areas, in the Southeast and in the Midwest. That's one of those large drivers. Electric gen with retirement is a Southeast story. Gulf-based industrial resurgence, renaissance, is a Gulf-based story. LNG is a Gulf-based story. The demand we see occurring is now centered largely in the South, and it's creating a bit of a problem. Certainly that largest story is going to be the LNG export story. The LNG market represents delivering gas on that infrastructure is only 10%. So if we think about global demand, the world consumes about 325 BCF a day of gas, okay? Only 10% of that is delivered via LNG. Now, the only fossil fuel over the long time, when we, Henry, you started off talking a little bit about the golden era of gas, the IEA report that came out. The only fossil fuel that has any chance of growth over the next decade is going to be gas. It's going to be natural gas. But the problem is consumers are getting increasingly uncomfortable with their form of delivery. They're not okay with being stuck to one producer at the end of the pipe. they're increasingly looking at LNG as a way to diversify their supply delivery and their choices. And so that will be a growth target. That market could likely double by 2025. Those are the aggressive targets, but it could. There's a lot of headwinds occurring against that. Some return of nuclear capacity out of Japan, the renewable growth, the fact that U.S. coal producers are going to be exporting a lot of coal the same time that U.S. gas producers are exporting a lot of gas. But nevertheless, that is going to be your south driver, your largest south driver, and that is really going to sort of change the way we think about gas. So since 2008, that gas, the gas pipeline I showed you, production growth of about 15 BCF a day. Well, consumers have not been sitting idly by. We've got about 8 BCF a day of demand growth in the U.S., but it's not been enough. The only way we balance is we balance on pushing out exports, and then when it gets really bad, like it did in 2012, and this year, we make it so awful that we see demand-side response, and in basins like the Northeast, we also make sure the suppliers are also going to keep as much gas as they can off the market. Now, I love this. I actually like it so much. I think I put you in there. Same slide I duplicated, so you're going to see that. And I apologize, but it's amazing. We have seen rapid midstream capacity growth. If you think about the last from roughly that same period over the last 8 years, what's interesting here is the diversity of where we've seen this access and growth. You've seen the Rockies Express pipeline, the most expensive, largest pipeline developed, pushing gas from west to east. You also see the migration in the Gulf, pushing gas from west to east. And you also see a lot of activity occurring in the Northeast. But what's interesting about this map is that you've actually seen a lot of pipeline activity that has been dispersed across the country. Fast forward, projects pending, they are really bound for one story, and it's the story I was telling, migrating that gas to any other place and keeping it within basin, migrating it to the Midwest, major projects going in, competitive projects. Energy Transfer's Rover project, that's a $3.8 to $4.4 billion project, okay? The Nexus project is also a couple $2 billion for Nexus, keep competing pathways. We can take a look at Spectra's project to actually take a look at that Northeast corridor, the AIM expansion coming in as part of the story, but larger, trying to build in. They also would like to have this access market to sort of fortify the existing pathing and develop more gas going into New England. It competes with, head-on, Kinder Morgan's project, the NED project. Each of these are several $1 billion. These projects account for that $20 billion. And even the ones that are kind of fast-moving, pre-filing to make sure they can get that support, we still see the same sort of path migration. On the storage side, you see nothing. You see crickets. Now, the problem we have here is that, remember, LNG is not a base-loading market. It is a seasonally peaking wintertime market. And so is, by the way, our consumption in the U.S. It is a Midwest-dominant story along with the Northeast, where you have some fuel diversity. You have a really interesting story brewing here because we're not building any more storage facilities. And moreover, our storage facilities were built and predicated on a whole different supply story. So they're not located kind of where we need to have them located, but we're not developing any more. When we take a look at those projects, the interesting projects that are growing, and EIA has underestimated, when they put this slide out, it was a complete underestimation, but it's interesting to see how they line up with regard to, is this a greenfield pipe? Is it going to be a bidirectional? Is it an expansion? What is this? And certainly, at least through 2017, this year has been really about reversing those pipelines. The Rockies Express now migrating east to west. That's one of the largest projects going in this year. Most of these projects, the low-hanging fruit is actually going to see those reversals. The first reversals are going to be your cheapest reversals. When we now have to migrate the gas path from the east to the west, now on those underutilized Midwest pipes, it becomes a lot more expensive. You start to see the pancaking of rates, and you start to get into an interesting story where all of a sudden some of the Gulf-based basins may compete simply because you've got to layer in that transport cost. But the greenfield development, I think, is going to be really hard. We're not used to developing greenfield projects, certainly in very populated areas. So you're going to hear something. It's co-located with an existing pathway. You'll hear these, but be really mindful on whether or not we're going to actually see all of this these projects move forward. Now, if they do, this is Range Resources. They say, well, you know what, gosh, we have a constrained market. 2016 still an issue of constrained market, so our ability to further grow that Appalachian Basin is going to be challenged. In fact, by the way, the pipes going in now, there's an absence of pipe projects really in 2016 until we get into November. And so what we have really through the winter is what we'll keep. And so that story where Randall said, hey guys, it'll likely peak during the wintertime. You don't have any more takeaway capacity. It's confined during this period. You're not free-flowing the gas. You will be free-flowing if those 2017 projects come in. In order of magnitude, you're looking at project capacity out of the region, 5 BCF a day this year, 5 BCF a day next year. If those billion-dollar projects go forward in 2017, you're looking in order of magnitude of 17 BCF a day of new takeaway capacity. When it's accounted for, and we think about this, so you see this range resource slide, and they talk about the fact that, you know, you're well into free flowing in 2016. I disagree, that's actually 2017. But you have a possibility of being overbuilt by 2018. Now, that's interesting. What they want to say to the public is, listen, don't worry about our gas. We're no longer going to have it captive in basin. We can move it out. What they're not mentioning is the fact that it comes at a cost. These producers are going to have a pretty significant bill for that overcapacity and build out. And we need to be mindful of how that's going to impact their earnings and ability to stay profitable in that period. I'm running off. Okay, yeah, okay. So this is where this is the drum roll moment that Henry's leading up to. So how does that change where we flow the gas? By 2020, we see roughly 11.5 BCF a day of new incremental gas out of the Appalachian market. It's interesting. Most of that is going to stay within the areas that are closest to it. It'll stay in the South Atlantic area. That's the largest area of growth, followed by the East North Central. Now, we've seen supply competition. The next area of supply competition is mid-continent. But for the fact that we have an export story brewing, these mid-continent producers would be in a whole hell of a lot of pain, because the fact is that they were depending on that East North Central market, the Midwest market. That's no longer going to be held captive by those producers. If they don't have that export market, they're going to be in trouble. But they do. They have Mexican export market and those Gulf LNG exports. In summary, I want to talk a little bit about how this is going to be disrupted without this reinvention. Certainly, the flow disruptions have weakened the regional price dynamic. You don't see the supply basin parity. You never will, by the way. This is just not what we're going to see. The parity comes in the form of transport and adding in that layered cost. We're going to have constraints. Those constraints are really off the table if these projects move forward in 2017. Now, remember, if they're off the table in 2017, you're going to experience Gulf-based weakness. All of a sudden, that gas is flowing into the Gulf, and you're going to see more gas-on-gas competition. Remember, the rippling of weakness around the Appalachian Basin now extends into the Gulf by 2017. Mid-continent region, that's the next region. They really have to seek that export relief. Now, the next story is that one of the stories that I think is going to be important is the Gulf-based storage. The Gulf-based storage, you can't give it away right now. But the fact is that taking a look at how these reversals will have to work, certainly during the seasonal time that we need them the most, I think that Gulf storage starts to become more interesting. Certainly if you take a look at the interstate pipeline filings, you've seen a real change in play on who actually is leasing that storage, and I think there's some merchant interest that's peaking up because of this particular story. And I think with that, quick wrap, turn it back to our moderator.
Thanks, everyone, for a series of very dynamic presentations about this wild ride that Matthew was talking about. Let's go straight to questions. You must have them. So raise your hands. Yes, you first, please.
We've seen producers able to use technology to really drop their costs, continue to produce, continue to return IRR. What inning in the game are we as far as technology things? Are we just at 82, or can it keep going down by another 40%, 50% in cost? Like, at what threshold do you think that engineering just stops?
I think we're like in the 5th, 6th inning, so I don't think we're like at the end of it. But I mean, the peak of your innovation growth, I think, was like the 08 to 2011 timeframe, but we just continued to build upon that. I don't think there's really any step changes coming. I think it's just kind of steady, continued growth. Producers figure out how to get the same EURs for spending less money. So it's just it's a slow, kind of gradual thing, other than areas where they're going to more horizontal drilling, where they're just not right now. I mean, like the Permian Basin over the last year.
And how much of that innovation, how much CapEx is that consumed? So as we see CapEx reductions, you know, your service costs are going down, that's great, but your engineering department at some point has to take it as well.
Yeah, I mean, right now there's nothing being spent on R&D, and that's why you're seeing the Schlumberger, the Halliburton, and those guys. They're cutting capital. A lot of the R&D typically happens with the service companies in conjunction with the E&Ps, and there's just not much being spent on it right now. So.
Yes.
Fernand, one thing you didn't talk about was energy storage, how that might influence generation as well as utilization of natural gas generation.
So, you know, right now, you know, maybe mid next decade, I think that we'll see more storage. It will certainly smooth some of the peaks. But, you know, I mean, it's going to have to count on a time spread. And purely by putting that storage in, you're going to get rid of your time spread. So there's probably a limited amount. You know, I mean, if storage is really great, there's, you can build pump storage in New England. You know, we haven't done that in probably 40 years. So. But yeah, I do agree with that. You know, I do think there's a point that we will see more storage in the future. It will help smooth. It will help smooth out the renewables. It's probably not helpful for gas demand.
Sort of follow up to Kurt's question, Randall. Do you see that $1.50 sort of shut-in threshold changing, you know, over the next 12 months? Is that going to go lower, or is it that $1.50 threshold kind of static for the next 12 to 18 months?
No, you know, it's kind of an operating cost type, and I don't see that really changing a lot.
Okay, static. Great.
Yes, here.
This one's for Terry. So on your last point here, cold storage will become increasingly valuable to smooth rising seasonality. How do you square that with Randall's point about production actually being seasonal, and in 2017, 2018, you're sort of debottlenecked in the Northeast, and say you have a demand increase in the Gulf to meet that rising seasonality, you maybe can offset that with production. How do those kind of balance out?
That's a great question. You know, so the amazing thing is we haven't cycled production since the 90s. So this is we're really chartering new areas. So we used to always cycle production. We'd ramp up in the wintertime and cycle back in the summertime simply because we had inadequate storage. Now with adequate storage, that was unnecessary until this year. This year's the first time that we've actually had to see real cycling in our storage, real cycling in our production as a means for regionally balancing the marketplace. And so, you know, the story that we're talking about is that we have this problem, which is the dynamic in the bidirectional pipe. You know, what we've done in this country is that we continue to, we can't consume. You saw, you know, there's more than 100 BCF a day of new pipe, right? It doesn't mean we can consume 100 BCF a day more gas in the country. The deliverability has not radically changed. In fact, deliverability has only increased by about 10 BCF a day. So the problem is, during that peak winter time, you have a real problem on the directional pipes and how we sort of think about this. Now, it may provide some benefit by being able to cycle the gas into the storage, Gulf-based storage during the summertime to sort of help with this dynamic. But I think we're going to have a real problem in sort of making this work. So all of a sudden, that dynamic, you know, if the U.S. is going to become a major player in LNG, in the LNG market, well, most of the world doesn't have adequate storage space. The Gulf becomes a de facto storage container for the rest of the world is what happens.
If I can just agree with everything Terry said, I think it's fundamentally a question of scale. And that's why I want to emphasize that the magnitude of the swings in demand that could occur by the time that we get to 2018, 19, 20 are wholly different than we've ever seen before. And so I look, at least I think there are plausible scenarios where you could have 1 year, for example, where we had very mild weather in the United States, potentially during also in the rest of the Western Hemisphere. Demand in the United States, weather-driven demand in the United States and Mexico could be depressed by 3-4 BCF a day compared to a more normal scenario. LNG demand could be very weak. There was a gentleman at a conference that Genscape co-sponsored yesterday from Bentec who predicted that LNG demand could be as low as 4 BCF a day, which might be as little as a third of the capacity by the end of the decade. So the point is, and then you have the seasonality of LNG demand that Terry's already emphasized. It kind of builds in some likelihood of swings during the year. And you add that all up. I've actually asked this question of Adam Szymanski from EIA, whether EIA has looked at this and thought about it. You add that all up, and you can see a year in which demand is depressed by 6, 7, 8 BCF a day from a normal level, and prices really tank. And the good news is existing storage gets filled, but prices really tank, potentially to the point that we see exactly what we're seeing in the Northeast, with prices down to $1.50 over very widespread areas. Drillers cut back, E&P companies cut back tremendously on new drilling, and part of the point that we made that it's important to know is that in the natural order of things, as drilling decreases, the backlog of drilled but completed wells may also decrease. And all of a sudden, you get exactly the opposite scenario. You get a very cold winter in the United States, maybe even a hot summer as well. In LNG, you get strong winter in Europe or Asia, and all of a sudden, every one of those factors reverses. And you get year over year potentially a 3 trillion cubic feet year over year increase in demand. And when you talk about that sort of scenario, with, as Terry's pointed out, really only, we definitely have some margin of true reserve storage capacity, but it's not huge. And we definitely have some flex capability of supply, but it's not huge. And so I think what potentially happens then in that scenario is that we go from extremely depressed prices one year to a period during the winter at least, where without the dampening effect of coal displacement, we potentially go to $10 for a period of time. And then it takes as much as, that's not going to last because we do have the ability to increase supply, but there's a lag period, and it may take 6 to 9 months for prices to go back to an equilibrium. That's my concern. The question for the panel members is whether they think these kinds of big year-over-year swings in demand are possible, and what might that do to prices.
Can you just ask Randall?
I think a quick, and also too is that, point we need to not forget this point is that, the Mexican market is an 8 BCF a day market that would like to be a 16 BCF a day market. And so we had a lot of questions about, we see all the pipeline capacity, we don't see a requisite number of combined cycles to sort of offset, forgetting the fact that Mexico, the industrials in Mexico have been used to the fact that they just simply they're interrupted all the time. They don't have a secure source of supply. All of the pipe is not spec pipe going into Mexico. This is to actually meet demand. And so that market may be as large as the LNG market we're talking about. It could be an 8 BCF a day market just to meet Mexican demand. And that is certainly going to play off those coal-based storage facilities.
Just to add volatility to that, like Andy was saying, what happens in 4 to 5 years when your deferred inventory is gone in the Marcellus? You're no longer constrained, you're flowing those wells all out, and you have not had the prices to incentivize more drilling. I mean, the rig counts we're at right now are not suggesting that you would actually grow production, but you have that deferred inventory in the constrained production. So say 4 to 5 years out, you're at 30 BCF a day, and you have those 60% first year declines you have to overcome. You have a situation like the Haynesville where you went from 7.5 BCF a day to almost 4 BCF a day in a year. So then you have to incentivize that with higher prices to get more rigs out there to drill more wells. Productive capacity is there, but I think in the next 5 years you're going to see highly volatile prices because of that.
Questions? Yes.
Just a follow-up for Randall on the lowering of break-evens. I was kind of curious as you think about those costs coming down 30-40%, you highlighted the fifth inning of the game. I guess the question is how much of that incremental here do you think comes on the back of services companies? Because when you look at the health of them today, the debt loads a lot of them are supporting. It calls into question how much further you can push the price on these guys. So I'm just curious, how much is engineering versus service pricing?
I think the service companies have definitely said, the ones I've talked to said they cannot go any lower than where they're at right now. it's a supply and demand issue. They just don't, and the only way they can cut anything more is to go cut, I guess, their employees' salaries, basically, to get that any lower. So to improve it much more, I think, is not going to happen. I mean, so you cut these costs by 30 to 40%, but in reality, the producers are drilling longer laterals. They're still only spending maybe 10% less on the wells themselves. So they're using some of the efficiencies to improve their overall economics and not necessarily just cutting well costs 30 to 40%. So
I think you need to add another dimension to all this too, which is the question of where is the CapEx going to come for the drilling. Essentially, we often talk about what's the break-even cost, the price for the well. That's very important, but I think we also need to start focusing more on what's the break-even point for cash flow. And obviously, when you had prices very high, the break-even point for cash flow is the point at which, having drilled and completed a well, you've got enough production so that if you look only at that well, you've more than paid back your cost. It was relatively soon. And so you had a lot of cash flow from your production program to fund new development. Now, when the prices are much lower, the margins tend to be much lower, and if you look at the cash flow, it really creates a huge question. If somebody's going to have to invest to incentivize the production, the banks are going to reduce dramatically the funding they provide. Even the private equity funds are likely to be more cautious, and if the capital isn't there, then even if on paper it's economic to drill, that may be a further source of volatility.
Can I just ask a question at this point and just bring in Vince and Matthew here? Andrew raised the point at the very beginning of his speech about the new EPA carbon rules, and I wanted to ask you guys what you think, what impact this is likely to have on the natural gas demand going forward.
Well, certainly it's going to have downward pressure on it. I mean, we're most familiar with the New England market, but we're already facing rapid and very almost violent opposition to gas projects. They're chaining themselves to trees and fences and gates and everything like that. So I just think it's going to be another level of that. Basically, now you've got, in my mind, that all goes back upstream to fracking. That's really the ulterior motive here. We've got low gas prices because we have a lot of supply. The demand that's going to accommodate that is the power gen demand. So let's, strangle demand. It'll go all the way back to the wellhead. We'll basically meet our agenda, without having to do anything else but limit that market. So that's my own personal opinion on it.
Matthew, I mean, is there a sense? Can you? I mean, is there an argument to be made about the importance of just baseload capacity? I mean, we've talked so much about the volatility that's going to be coming into prices here. Aren't those rules likely to impact stability of supply?
Gas supply or
gas?
Yeah, so we don't have as a negative view as Andrew did about the Clean Power Plan. And that's kind of asking for that effect. Yeah. So we think in the near term. All right, so first, look, it's an EPA rule, and it hasn't hit court yet. So it's 50-50 at best, right? So with that in mind, suppose it does go through. We think through maybe 2025, it's helpful for gas demand. But right now, I'm already past my 5-year period where I know anything very much about power markets. It's talking about that. So then, it's a big question, right? IPM modeling is one thing. It shows one thing. You can find a spectrum of studies depending on who pays what to find something else. So we think probably, if you sort of think of the current combined cycle fleet, sort of same store sales go up through 2025, and then it's kind of a crapshoot after that. And it's an interesting rule in the sense that every state can have its own implementation. It's not like the SO2 rules that affected the whole United States or cross state that has big sections. every state can do its own thing. And so there's a tremendous amount of uncertainty that concerns us just about how states implement it and how does that affect regional power markets, and could we get strange incentives in some state might want to protect coal and come up with a way to do that, and some by adding a few more renewables or something like that. So, it creates uncertainty, certainly.
If I could just say briefly, two things. One, it does depend very greatly on on the compliance strategy that the states adopt. And one of the reasons I raised the point generally is that I hope that the natural gas industry will become more active than it's been in trying to influence what happens next. Calpine was actually extremely active and effective in influencing EPA's policy under this final program. The rest of the industry, the gas side of the industry, was noticeably missing in action in terms of having an effect. The most important point, I'm trying to make only a broad general point. I agree that for a period of time, it'll be good for existing generation. But my point is, there is a tremendous future opportunity for further expansion of gas use with new generation. And then overall, this program has a number of very specific features that are designed to inhibit that. And that, I think, is a problem, and I hope the industry will look for ways to make things better.
Hi, we've got time for about 2 more quick questions. Yes?
So mine, at the risk of making this answer far too long to take up all the time, the second question, I'll ask it anyway. We're looking at a near-term bearish environment with potential huge volatility, right? That's kind of our near-term outlook on American gas. I'm curious what it's going to take to get us back to something that could be sustainable in the $4 range with potential high volatility as opposed to something kind of uninteresting like you did.
I think that's a great question, actually, to end on. So, guys, why don't you...
So we obviously, with incenting domestic consumption over the last 8 years, we haven't been able to move price, right? The needle's now moved on price, it's just moved lower. So 15 BCF a day of production only offset maybe 8 BCF a day of demand. Domestic consumption alone can't move the needle. But all of a sudden, unlocking the ability to get the gas now further afield to markets in Europe, to markets in Mexico, to the eastern half of Canada, I think really is going to be a game changer. Combine that with the fact that we start to work through that inventory of wells, and you have a much different dynamic developing. We have a better sense of the cost of the gas, location of the gas, and by the way, that next pipe now means that the cheapest pipe is the pipe in front of you right now. The next pipe gets a lot more expensive. Even with co-locating pipe, the fact is the Northeast is not comfortable with switching out the diameter of your pipe. So we like to make it really comfortable, but even swapping the diameter means a tremendous environmental change in where we're pushing the pipe and the gas. So I do think opening the borders is going to be a game changer on price.
Well, I have a hard time believing you'll ever get to a long-term equilibrium price because we really haven't seen that before. Basically now in a low-price environment, producers have adjusted and economics have gone down. On the other side, when rigs start increasing again, economics say to go drill again, all that's going to do is drive up your costs. So the costs got to go up where the prices are, and they'll go down where the prices are. So I don't know if you'll ever truly see that $4 equilibrium price.
If I can redefine the question slightly, I agree with Randall completely. I don't think we'll ever see a sustained $4 price, but I think the important issue is margin and returns. And I think we can see in the industry where as costs decline, that the margins and returns can go back to pretty robust levels. And I think to get there, the answer I think is clear. It has 2 parts. A part of it is to understand the price volatility that's coming and be quick and not greedy to capture opportunities to hedge on attractive terms. And the second, the more fundamental answer, I think, is that there's a need for the natural gas industry and large users to move to an entirely different business model. And the volatility that we've all described, I think, is potentially high risk for both producers and end users. For producers, as the pathways out of Marcellus and Utica expand, and as Haynesville becomes more economic, and as we see recompletions become a factor, et cetera, et cetera, et cetera, you guys all know the list. The risk that the market will frequently be significantly oversupplied, and we'll see prices below $2 and very poor environment for producers on a widespread basis, I think is very high. From a user's perspective, $10 prices, even for just a few months, are death, and that's to be much avoided. And I think the way to get to sustain healthy margins, at least for the more efficient producers, is to square the circle by business deals, basically, between producers and end users that provide more stability in pricing. And it could be its own session, and I won't say anything more in terms of content. I'll just sort of pound the table a little bit. That, at least personally, I believe that moving to a very different business model is essential both for financing and to have a sustained, healthy E&P industry on the gas side.
Great. Well, I think we'll use that to wrap up today's session. And can I ask you just to thank very much through your applause our